welcome once again to this online course on financial institutions and markets. I am Dr. Sonam Bhadoria, Assistant Professor at Swami Rama Himalayan University. In today's session, we will be exploring one of the most secure and foundational short-term instruments in the Indian money market, that is Treasury bills, often referred to simply as T-bills. These instruments are crucial for understanding how the government borrows money for short durations and how institutions invest in our risk-free assets. Whether you are preparing for a career in finance or simply trying to understand how the economy functions, Treasury bills form a basic yet vital building block of public finance. Let's begin by understanding what Treasury bills actually are. Treasury bills are short-term instruments issued by Government of India through the Reserve Bank of India to meet temporary funding needs. These instruments are issued at a discount to face value and redeemed at par on maturity. This means that the investor does not receive any interest payments periodically but instead earns a return through the difference between the purchase price and the maturity value. This difference is basically the return for the investor. Since these bills are backed by the government, they carry zero default risk and are considered as one of the safest investment options in the Indian financial system. The origin of Treasury bills in India can be traced back to the early years of post-independence financial planning, when the government needed mechanisms to bridge short-term budgetary gaps without relying on long-term borrowings. Over the decades, Treasury bills have become an essential tool in the Reserve Bank of India's monetary policy and liquidity management framework. They are used not only to raise funds but also to signal interest rates and absorb excess liquidity from the banking system. There are three types of Treasury bills currently issued in India: 91 day, 182 days, 364-day bills. The number indicates the time to maturity from the date of issuance. Among the 91 days Treasury bills is the most frequently used and actively traded Treasury bills. The 182 days and 364 days bills are issued based on the government's short-term financial needs and are usually favored by institutional investors with slightly longer investment horizons. These Treasury bills are issued through auctions conducted by the Reserve Bank of India on a weekly basis. The bidding process can be competitive or non-competitive. In the competitive bid, investors quote the price they are willing to pay, whereas in a non-competitive bid, the investor agrees to accept whatever cutoff price is determined in the auction. The minimum bid size for Treasury bills is rupees 25,000 and in multiples thereof like 50,000, 75,000, 1 lakh and so on, making them more accessible to a wide range of investors. Though mostly subscribed by institutional investors like banks, mutual funds, and insurance companies. Retail investors can also participate, particularly through non-competitive bidding channels or mutual funds schemes. The electronic auction system and dematerialized form of issuance have further simplified access to these instruments. The treasury bills are the popular instrument in Indian money market. One of the reasons treasury bills are so important is their role in helping the government manage its cash flows. For example, if tax revenue in a particular financial year are delayed for expenditure obligations need to be met before inflows are received, the government can issue treasury bills to bridge that short-term gap of the fund. Additionally, the Reserve Bank uses treasury bills in open market operations to control liquidity in the financial system. When the Reserve Bank of India wants to reduce excess money supply, it sells treasury bills, thereby absorbing money from the market. Conversely, when it wants to infuse liquidity in the economy, it may repurchase them. Now, let's understand how returns from treasury bills are calculated. Since they are issued at a discount and redeemed at par, the gap between the issued value and the sale value is the return of the investor. The return is computed as the annualized yield based on the difference between the issue price and the face value. For instance, if a 91-day treasury bill with a face value of 100 is issued at rupees 98, on the return to the investor is rupees 2. On an annualized basis, this return can be expressed as a percentage to allow comparison with other interest bearing instruments. The shorter the maturity, the more sensitive the returns are changes in interest rates and liquidity conditions in the economy. Treasury bills are widely regarded as risk-free instrument, but they come with some limitations also. Since the returns are relatively low compared to other investment options, if you see 2% is actually a very low return, but the certificate of deposits, commercial papers, they may be attractive to investors seeking high returns. Also, while treasury bills are tradable in the secondary market and the liquidity varies depending on market conditions, they are also impacted by the market conditions. Institutional investors may actively trade them, but retail investors usually hold them till maturity due to limited access to secondary market platforms. And one of the most significant advantages of treasury bills is that they are eligible for statutory liquidity ratio, or popularly known as SLR investments for banks, which means banks can fulfill a part of their regulatory obligation by investing in treasury bills, making them a preferred choice for treasury managers. In addition, treasury bills are exempt from capital gains tax if held till maturity, although the discount earned is treated as interest income and taxed accordingly. This makes them a tax efficient option for the investors in lower tax brackets. So, we can say it is a good option for saving tax also. So, let me give you a practical example related to Treasury bill investment. Suppose a mutual fund has received fresh inflows and needs to park the money for a few weeks before reallocating it to the longer term instruments. And instead of leaving the funds idle or exposed to risk, the fund manager may choose to invest in a 91-day treasury bill. This offers safety, predictable returns, and liquidity. On the other hand, the government benefits by raising funds quickly at a low cost. It's a win-win scenario for both the parties, either the mutual fund company and the government. The market for treasury bills in India has grown significantly in terms of volume and participation. Number of people investing in treasury bills has increased a lot in the last years. Weekly auctions are now conducted electronically and the settlement happens through the Clearing Corporation of India, which ensures transparency and the efficiency in the process of issuing the treasury bills and the returns also. The total outstanding stock of treasury bills often runs into several lakh crore rupees, reflecting their importance in the overall fiscal and monetary ecosystem. The rates on treasury bills are also used as a benchmark for pricing other instruments, including commercial papers, certificates of deposits, and even some types of floating rate bonds also. The treasury bill have also a future. So, if we talk about what is the future of treasury bills, so looking ahead, treasury bills will continue to play a vital role in India's financial architecture. As the government's borrowing needs evolve and market dynamics shift, the use of short-term instruments like treasury bills will become even more sophisticated. There is also a growing push to increase retail participation through platforms like RBI Retail Direct, wherein the individual investors can buy treasury bills and other government securities directly without involvement of any third party, or we can say without any intermediary. This will democratize access and make the financial system more inclusive, more participative. To summarize this session, we can say that treasury bills are short-term, risk-free debt instruments issued by the Government of India to meet its short-term funding needs. Like a corporate, like an individual, government has also its short-term funding needs. They are fulfilled by the treasury bills type of instruments. They come in maturities of 91 days, 182 days and 364 days and are sold at a discount and redeemed at par. They are auctioned weekly by the Reserve Bank of India and are primarily used by institutional investors, though retail access is improving. Treasury bills offer safety, liquidity and flexibility and play a critical role in monetary policy, cash management and banking regulation. So, as we close today's session, I encourage you to think about a few questions like, why do treasury bills have such a prominent place in the money market? How they actually help the Reserve Bank of India in managing its monetary policy? And finally, what more can be done to increase retail's participation in these safe investment options? As you know, more investment, more returns. more investors, more return. So thank you for joining me in this session on Treasury bills. In our next lecture, we will explore the world of commercial bills. Again, one another important component of short-term finance, especially in trade and commerce. Until then, keep exploring, keep reflecting, and continuing strengthening your foundation in the concept of learning money and financial system of India. Thank you. Namaste.